Okay, Frank, stop. I'm looking at these numbers, and you're telling me that getting paid actual cash, like quarterly dividend checks, is somehow costing people a house?
Well, yeah, look, I know it sounds completely backward, but the real math, over a 30-year window, it is brutal. We're talking about a $370,000 gap.
$370,000 just from picking dividend stocks over an index fund? Amazed, speaking slowly. That's terrifying. I mean, we always hear that passive income is the holy grail.
Right, which is exactly why we need to unpack this today, because the industry is heavily marketing this to families, and it's literally draining their wealth.
Which makes this mandatory viewing. I'm Lynn.
And I'm Frank. And if you're new here, well, welcome to Talk and Wonder. We're the ones drawing those whiteboard animations to, decode the financial traps Wall Street sets up for families.
Exactly, because our goal is to build wealth together, not hand it over to the IRS through hidden leaks. So if you're trying to secure your family's future, grab a coffee. You are going to want to hear this.
So let's set up a scenario. Let's use our usuals, David and Sarah.
Oh, I love a good David and Sarah showdown. Okay, let's do it.
Right? Okay, so let's keep it completely fair. They're both 30 years old. They both make, say, 75 grand a year. Same city, same tax bracket, same exact goal.
To retire comfortably and not be a burden on their kids. Got it.
Exactly. And they both invest the exact same amount, $1,000 every single month for 30 years in a regular taxable brokerage account.
Okay, so 1,000 a month, but they pick different strategies, obviously. Let me guess, David is our dividend guy.
You know it. David builds a dividend stock portfolio. He spreads his $1,000 across, a mix of dividend aristocrats.
Like the classic blue chip ones, Coca-Cola, Johnson & Johnson.
Yeah, Procter& Gamble. Plus, he throws in some high-yield ETFs like SCHD or JEDI and a couple of REITs just to bump his yield up.
Right, because he wants to see that cash flow.
Exactly. So his average yield comes out to about 4%, and every quarter, real money just hits his account.
And he reinvests it automatically, right? Because that's what all the YouTube gurus tell you to do. Let the snowball roll.
He does, and honestly, it feels incredibly strategic. He feels active. He watches those dividend checks land, and he feels like he's already building this tangible passive income machine.
Okay, so what about David? Let me guess, she's doing the boring thing.
Almost embarrassingly simple. She just buys VOO, the Vanguard S&P 500 Index Fund. Every month, $1,000 goes in, and she walks away.
No individual stocks.
None. She doesn't research companies. She doesn't track yields. She literally just buys the entire U.S. stock market and goes back to her life.
I mean, I totally get why David feels like he's winning. At a weekend barbecue, David has a story, right? He can say, let me tell you about my cash flow from Apple and Coke. Nobody stands around the grill saying, hey guys, let me tell you about my broad market index fund.
Exactly. It's not a power move. But, and this is a massive but, feelings and math are two very, very different things.
Okay, so what happens? Because for the first few years, David has to look like the genius here.
He absolutely does. By the end of year one, David's portfolio is paying him about $480 in dividends. Year two, $1,000.
Nice.
Year three, $1,400. By year five, his portfolio is throwing off close to $2,800 a year. Every single quarter, money lands in his account that he didn't even have to work for.
Which is the dream. I mean, if I'm David, I'm looking at Sarah and thinking, what are you even doing? Because by year 5, Sarah has what, like $73,000 in her account?
Roughly, yeah.
But she's getting nothing. No checks, no notifications on her phone, just a number going up on a screen.
Right. On every visible scoreboard, David is crushing it. But, well, here is what David doesn't see, and this is the part that Wall Street has known for 60 years and David's YouTube feed has conveniently never mentioned.
Oh boy, here we go.
Every single dividend payment he receives, it's taxable income in the exact year it paid.
Wait, even if he reinvests it automatically?
Even if he reinvests every single penny and never touches it, the IRS does not care. They still take a cut every April. And worse, his passive income isn't new money appearing out of nowhere.
What do you mean? If it's a dividend, isn't it a bonus, like the company sharing its profits?
That's what everyone thinks, but it's actually, well, it's his own share value being handed back to him.
Wait, so you're saying they take his own money, hand it back to him, and then the government taxes him for the privilege?
Literally, yes. It's a concept that almost no dividend influencer ever explains. It's a concept that almost no dividend influencer ever explains. In the finance world, it's called dividend irrelevance.
Okay, that sounds very academic. Break that down for me. What actually happens when a company pays a dividend?
All right, let's look at the math on the actual ex-dividend date. Let's say you own a stock and it trades at exactly $100 a share.
Okay, keep it simple, $100.
Right. And the company announces a $2 dividend. Most people think, awesome, I have my $100 share, plus I just made $2 in cash. But that is not what happens.
Okay, what happens the next morning?
The next morning, when the market opens, that share price mechanically drops by exactly the dividend amount, so it opens at $98.
Wait, so the stock is just worth $98 now?
Yes, you didn't magically gain $2 of new wealth. You have a $98 share and $2 in cash. The total value is exactly the same as the day before.
Are you serious? So it's literally just taking $2 out of my left pocket, putting it in my right pocket, and what, clapping for myself?
Clapping for yourself. Exactly. That is a perfect way to put it. You just moved money from one column to another. Except, and here is the part that hurts,
Oh God, there's an except.
except the IRS is standing right between your two pockets.
Of course they are.
Because remember, the second that $2 hits your right pocket, it becomes a taxable event. You owe taxes on it. And the share price went down by the same amount. So it's not actually income in the way we think of a paycheck.
Right,
It's a forced partial sale of your own position. You are essentially being forced to sell a tiny piece of your investment, pay taxes on it, and then, if you reinvest it, you're just buying back your own shares with less money than you started with.
Wow, okay, I need a second. Speaking slowly, a forced partial sale of your own position. That completely changes how you look at those quarterly checks.
And this isn't some controversial, hot take. This has been settled finance theory since the 1960s. Miller and Modigliani published this in 1961, but your passive income feed
Just completely ignores it because forced partial sale doesn't get clicks on YouTube.
Exactly. Now, let's talk about the real damage here, the annual tax drag, because every dividend David receives is taxable the year it's paid.
Okay, but how bad are those taxes really? Like, aren't dividends taxed at a lower rate?
Well, it depends. There's the friendly version, which is qualified dividends. If you hold U.S. companies for a certain amount of time, you get long-term capital gains rates, so 0, 15, or 20%, depending on your income.
Okay, 15% isn't terrible.
No, it's not. But remember David's portfolio. He holds REITs, real estate investment trusts, and high-yield ETFs like JEPI to get that juicy 7 or 8% yield.
Right, he wanted the high cash flow.
Those pay non-qualified dividends, which means they're taxed as ordinary income, literally the exact same rate as your paycheck from your day job.
Wait, so all the way up to what, like 37%?
Up to 37% plus state taxes. So a massive chunk of his passive income is being taxed at his absolute highest marginal rate.
Okay, but Frank, let me play devil's advocate here. Even with taxes, we're talking about a few bucks here and there on a $1,000 monthly investment. Does that really add up to a missing house?
The math says it does. Over 30 years, David's dividend tax drag costs him roughly 0.5 to 1% in annualized returns.
See? 1%. That sounds tiny.
It sounds tiny, but on a 30-year compounding window, a 1% drag turns into roughly $300,000 in lost wealth.
Frank, stop.
I'm serious.
$300,000 from a 1% leak?
Just from the tax drag and lost growth. Not 30,000, not 50,000, 300,000 that David never even saw because it was siphoned out before it could compound.
So he's bleeding out slowly, but he doesn't feel it because his account balance is technically going up.
Precisely. And you know what people do when they realize their portfolio isn't growing as fast as they want? They try to fix it by chasing even higher yields, which leads us straight into the second trap, yield chasing. Because when that 4% yield stops feeling like enough, investors start looking for, 6%, 8%, sometimes 10%.
Oh, guilty. We've all seen those thumbnails. Make $5,000 a month with this one 9% yielding stock. It's so tempting.
It is. But here's the reality. In the stock market, high dividend yields are almost always a symptom of distress, not strength.
Wait, really? But isn't a high yield a sign that the company is super generous and profitable?
No, it's usually a sign that the share price just collapsed. Remember, yield is just the dividend divided by the share price. If the dividend stays the same, but the stock price crashes by 50%, the yield suddenly looks twice as high. It looks like a deal.
But you're catching a falling knife.
Exactly. Let's look at a couple of historical examples that burned a lot of families. AT&T. For years, this was marketed as the ultimate safe, sleepy dividend stock for retirees, right?
Oh, yeah, totally. Everyone's grandpa owned AT&T for the dividend.
Right. Well, in 2022, they cut that dividend nearly in half. Or how about General Electric? GE used to be one of the most reliable dividend payers in American history. They paid $1.24 a share annually.
Okay, and what happened?
They slashed it down to a penny, 1 cent.
Oh my God, 1 cent?
1 cent. Or Wells Fargo during 2020. They cut their dividend by 80%. And here is the thing that David doesn't realize. When these companies cut their dividends, the share price almost always crashes at the exact same time.
So investors who chased that yield didn't just lose their income, they lost their original money too.
They lost capital, yes. David's whole strategy assumes the dividend is reliable. History says it isn't.
Okay, so maybe David decides to play it safe. He avoids the crazy 10% stuff, sticks to the solid companies. Is he safe then?
Well, safe is relative. He avoids the crashes, maybe, but he runs straight into another wall, sector concentration.
Meaning he's only buying specific types of companies.
Right. Dividend portfolios naturally skew heavily towards financials, utilities, energy, and consumer staples. Banks, oil companies, toilet paper manufacturers.
The boring stuff.
The boring stuff, which means David systematically underweights the technology sector.
Ah, and tech is basically what's driven the entire U.S. market for the last 20 years.
Exactly. Apple, Nvidia, Amazon, Microsoft. David essentially opted out of the part of the market that's been compounding the fastest, and he probably didn't even realize that's what he was doing.
Okay, but Frank, this is what I don't get. If he's underperforming that badly, missing out on tech, bleeding money to taxes, why doesn't he stop? Why does he keep doing it for 30 years?
Because of the most dangerous trap of all, the behavioral trap.
The behavioral trap?
Yeah, the dividend check feels like proof that the strategy's working, even when it isn't.
Oh, wow. So it's like a psychological smokescreen?
That is exactly what it is. Look, David's portfolio could underperform Sarah's index fund by, say, 15% a year for an entire decade, and David would still feel like he was winning.
Because the cash keeps hitting his account every quarter.
Exactly. Every notification on his phone that says you received a dividend releases dopamine. He's not comparing his total return to the S&P 500. He's just looking at the cash flow. It hides his underperformance from the only person who needed to see it, himself.
That is actually really sad. But okay, let's be totally fair here. Sarah's index fund strategy isn't perfect either, right? Like there's no way she gets a free pass.
No, you're right, it's not. If I only showed the downsides of dividends, I'd be doing exactly what we complain about the YouTube gurus doing, telling half the truth. Index funds have real limitations.
Let's hear 'em. Lay it out.
Okay, limitation number one, there is zero income stream. When Sarah retires, she cannot live off her portfolio without physically selling her shares.
Which is scary. I mean, for someone who wants the psychological comfort of a check, having to log in and hit sell every month is a huge mental hurdle.
It's a huge concession. And number two, index funds are market cap weighted. That means a small handful of mega cap tech stocks, the ones we just mentioned, make up a massive portion of the index.
So if tech crashes, Sarah's whole portfolio feels it hard.
Hard. She owns the broad market, but the broad market is way more concentrated at the top than people realize. Plus, she owns everything, including the losers, including the wildly overvalued companies in the middle of a bubble.
Right, because an index fund doesn't filter for quality, it just buys everything on the list.
Exactly. But here is where the rubber meets the road. Notice how the list of downsides compares.
Let me guess, one is mathematical and one is emotional?
You got it. David's costs, the tax drag, the expense ratios, the underperformance, those are mathematical. They drain real dollars. Sarah's costs are mostly behavioral. It takes discipline to hold an index fund when it drops 34% in 5 weeks like it did in March 2020.
Because she has no cash flow to comfort her.
Right. But if she holds on, the math rewards her in a way David never sees coming. Let's fast forward to year 30. They're both 60 years old. They both want to retire. So let's fast forward to year 30. They are both 60 years old. They both want to retire. After 360 months of consistent, boring investing, let's look at the actual balances.
Okay, the moment of truth. What are we looking at?
Sarah's index fund balance, approximately $1.78 million.
Wow, okay, close to 1.8. Good for her. And David?
David's dividend portfolio balance, approximately $1.41 million.
Wait, what? 1.41? So that's...
That's a gap of roughly $370,000.
Okay, I need a second. $370,000? That's not a rounding error, Frank. That's a fully paid off house in a lot of states.
It is. And remember, David never knew he was leaving it on the table because his statement always said his portfolio was going up and his dividend checks always confirmed his strategy was working.
Because of the psychological smokescreen we just talked about.
Exactly. But it gets worse. Let's look at the cumulative federal taxes they paid during that 30-year accumulation phase.
Oh boy.
David handed the IRS roughly $48,000 in dividend taxes across 3 decades.
$48,000?
Yep, and Sarah, she paid roughly $3,000.
Are you serious right now? $3,000 total over 30 years?
Because index funds barely generate taxable distributions. They don't actively trade. So that's a $45,000 swing, money David handed to the government that Sarah kept in her account compounding.
And that compounding is what built the $370,000 gap.
Bingo. 3 small leaks, the return drag, the tax drag, and the expense fees, running simultaneously for 360 consecutive months.
God, that hurts to hear. But okay, they're retired now. They're 60. They both need money to live on. Say they need like $50,000 a year. David has his cash flow, right? He doesn't have to sell shares. Doesn't he finally win here?
On the surface, it looks like it. His portfolio is throwing off roughly $56,000 a year in dividends. He doesn't click sell once. The cash just arrives.
Sounds perfect.
Until you remember the IRS. David owes taxes on every dollar of that $56,000. So after federal taxes, he actually takes home maybe $48,000 or $50,000.
Okay, but Sarah has to sell shares. She's physically depleting her portfolio.
True, she has to sell $50,000 worth of shares. But here is the massive, massive advantage that almost nobody talks about. Sarah has total control over when and how much she realizes in capital gains.
What do you you mean?
Long-term capital gains tax brackets are extremely generous if you manage them right. In the U.S., a single filer pays 0% on long-term capital gains up to roughly $48,000.
Wait, 0%?
0%. And because Sarah has been holding these shares for 30 years, when she sells $50,000 worth of stock, only a portion of that is actual gain. The rest is just a return of her original investment, which isn't taxed at all.
Oh my gosh, so by managing her withdrawals, Sarah can keep her taxable gains completely under that 0% threshold.
Exactly. Her federal tax bill on a $50,000 retirement income year, it could be essentially zero. She takes home the full $50,000. Meanwhile, David is paying $6,000 to $8,000 just on his dividends.
Frank, stop. That is wild. Same retirement, same income need, but completely different tax outcomes.
And we haven't even gotten to the final boss.
There's a final boss?
Yeah, estate planning, death. What happens when they pass away and leave this money to their kids?
Oh, wow. Okay, yeah, this is huge for families. What happens?
If Sarah dies holding her index fund and leaves it to her kids, they inherit it with what's called a step-up in basis.
I've heard of this. It resets the clock, right?
Exactly. The cost basis resets to the value on the date of her death. All those decades of capital gains wiped clean. Her kids could literally sell the entire $1.78 million portfolio the next day and owe $0 in federal capital gains tax.
That is incredible. And David's kids?
David's kids get the remaining portfolio, but remember, David has been paying taxes every single year of his life on those dividends.
There's no recovering that money.
None. The same dollar amount inherited results in a dramatically different after-tax outcome for the family. It is one of the largest legal tax advantages in the U.S. Code, and index fund investors capture it fully.
Okay, so it's a complete blowout. I mean, the math is just screaming index funds. So why does anyone ever buy dividend stocks? Is it literally just a scam?
No, actually no. If I left it there, I'd be telling a one-sided story again. There are situations where dividend stocks genuinely make sense.
Really? After all that? Where?
They belong in one very specific place. They belong in one very specific place inside a tax-advantaged account, specifically a Roth IRA.
Oh, because a Roth IRA grows tax-free.
Exactly. If David holds his exact same dividend portfolio inside a Roth IRA, that entire critique I just laid out, it completely collapses.
Wait, really? The whole thing?
The whole thing. The annual tax drag, the single biggest cost that drained his $370,000, disappears entirely. Dividends inside a Roth IRA are never taxed, not when they're paid and not when you withdraw them in retirement.
Okay, so if you're watching this and you just love the idea of dividends, put them in the Roth.
Put them in the Roth. Putting high-yield dividend stocks in a regular taxable brokerage account when you still have Roth IRA space available is, well, it's one of the most expensive mistakes a retail investor can make.
That makes so much sense. Keep the cash flow psychology, but legally cut out the IRS.
Right. And there's one more scenario where dividends genuinely make sense. It's for retirees who are already, 5 to 10 years out from pulling the trigger on retirement.
Because at that point, they care more about stability than crazy growth.
Exactly. Shifting a portion of your portfolio toward dividend growth stocks like the dividend aristocrats can provide that psychological certainty we talked about. There is real value in an 82-year-old not having to make the stressed-out decision of what should I sell this month.
Yeah, I mean, if dividend checks are what keeps someone from panic selling during a crash, then that behavioral advantage is probably worth the mathematical cost.
100%. The best strategy is always the one you'll actually stick with. But notice the pattern here, Lynn.
Yeah, every time dividends win, it's conditional, like it's for this specific account or this specific age.
Exactly. It's situational or supplementary. It's a complement to your core strategy, not a replacement. But for the broad accumulator audience, the family's just trying to build wealth over the next 20 or 30 years.
The index funds win.
They win on tax efficiency, they win on diversification, they win on cost, they win on control over your capital gains, and they win massively on estate planning for your kids.
So it really comes down to what goal we're actually chasing.
That is the core trap. The trap isn't that dividend stocks are evil. The trap is being told by the internet that passive income is the goal.
When the actual goal is...
Total return. Dividends aren't free money. They never were. Every dollar of dividend income you collected this year cost you in taxes, in lost growth, and in compounding you will literally never get back.
So build the core engine with index funds. Keep the math working for you, not the IRS.
Exactly. Because winning slightly less than you should for 30 years is exactly how people end up with a six-figure shortfall they can't explain. And by the way, if you're wondering how both of these strategies stack up against just buying a single growth stock and holding it for 30 years,
Oh boy, that is a completely different math problem.
it is, and the numbers on that one, they might actually shock you even more.